Hello friends, while presenting the budget of 2024, the Finance Minister proposed a change in tax law. The change is of removal of angel tax, and she claimed that this will help the startup units and the entrepreneurs by way of reduction in the tax and by way of removal of extra efforts, extra cost which is required by the entrepreneurs for getting assessed under this angel tax. Generally, for taxing anything, the government has to pass an act. For example, for taxing the income, the government has passed an act called as Income Tax Act. For taxing the sale of goods and services, an act called as GST Act has been enacted. The Customs Duty Act levies customs on import of goods. Excise duty is imposed on manufacture of the goods. The point is, for levy of any tax, an act is required to be passed by the government. Then is it the case that for angel tax there is a separate enactment? The answer is no. There is no separate act called as Angel Tax Act in India. This angel tax is a part and parcel of income tax, because in Income Tax Act there is section 56(2)(7)(b) which has created the provision for levy of the tax, the nickname of which is angel tax. So angel tax is a tax on income of a particular nature, and it has got no separate enactment, and this tax is, or this section is included in the Income Tax Act in 2012. This angel tax is a tax on companies issuing shares at a value exceeding the fair market value of their shares. So a company, when issues the shares, charges something more than the face value of the share. Every share has got a face value, but the shares are not issued at the face value. When the companies issue the shares at a price which is more than face value and also more than the fair market value of the share, the role of angel tax comes into picture. So three things we will have to keep in mind. Number one is that the company issuing the shares should be privately held company. That is, it should not be a public company in which people are interested. Second is, the shares may be issued to residents or non-resident investors. Third, the shares are issued at a price more than fair market value of the shares as well as the face value of the share. And the excess amount which the company collects by issuing these shares more than the fair market value of the shares is called as the profit to the company, and this profit is taxed under the head angel tax. There is no word angel tax in the Income Tax Act. I repeat, it is just a nickname. It is the name which we use in common to know what type of income is taxed. And normally the startups issue these shares at a price more than the face value or more than the fair market value. While charging this tax, of course this tax is charged under the heading income from other sources. So there is no separate rate of tax. There is no separate head of tax as angel tax. It is included in income from other sources and it is taxed along with other sources of income like salary, income from business, house property, etc. Now, for calculation of this angel tax, as we saw, two relevant terms are important. Number one is what is fair market value of the shares, and number two is at what price these shares are allotted by the company to the investor, to the shareholder. The price which company charges is very easy to ascertain, but the fair market value of the share is a technical thing for calculation, and the Act has provided two methods for working out the fair market value of the shares. One method is called as the discounted cash flow method, and the second one is the assets valuation method. Under the first method, the cash flow of the company in coming few years is discounted at a given rate. So there could be a difference of opinion. How many years are to be considered for discounting? At what rate discounting is to be made? And what is the cash flow to be discounted? These three things may vary and the opinions may change. Therefore, it becomes difficult to find out the fair market value under discounted cash flow method. And the second method, as I said, is called as assets valuation method. Again, it becomes very difficult to value the assets, particularly when the assets are intangible, like goodwill, like copyright, like patents. So it becomes difficult to make the valuation. And hence, since both these things are subjective, there could be differences of opinion between the taxpayer and the tax assessing authorities, and that normally creates dispute between the taxpayer and the tax-paying authority. Now, this removal of this tax is going to benefit startups, as is said by Finance Minister. How is that? The word angel refers to an investor who invests in a new company, a new venture, or a new technical business. An entrepreneur who has technical know-how, an entrepreneur who is efficient, who is able to do something new, start a new business. Such promoters, when they start the business, they may have ideas, they may have technology, they may have contacts, but they may lack capital. For raising the capital, normally there are two ways. One way is to go public, that is, issue the shares on the stock market and collect the funds. But when you are a new company, it becomes very difficult for the company to collect the funds from the market, because the company and the directors or promoters may not be having that goodwill in the market. They may not be known to the investors. Therefore, going public may be difficult, or the entrepreneur may not be willing to go in for public issue. Second way is going to the bank and collecting the money by way of loan. But the banks normally need what is called as security or guarantee, or both. This new entrepreneur may not be having any assets to offer as security, as well as he may find it difficult to get the guarantees of such an amount required. So that option also becomes difficult. In such a case, the entrepreneur has to approach the private investors. On the other side, some investors, high net worth individuals, they are also in search of such entrepreneurs who have got some new idea, some new technology, and they are also searching for a good place of investment. They can contribute in the form of their expertise, their experience, their contacts, and so on. When these two ends meet each other, that is the entrepreneur on one hand, that is a technocrat, and the investor on the other hand, if they come to some conclusion, some agreement, then the investor will invest in such new company or the startup. And for that new company or the startup, he becomes an angel because he is investing without security. He is investing without guarantee. He is ready to take the risk. Risk is of two types. One is viability of the project, and the second is how long it will take for this business to establish and start returning money. Hence, for the startup, such an investor is called as angel investor. Now, if we consider that angel investor's point of view, we can very easily understand that he takes the risk. And for taking the risk, he is interested in getting some more returns than the rate of interest. And he also needs some share in the business, some share in the management. So accordingly, the agreement is made. And for such extra expectations, the entrepreneur also may put a condition that shares will be allotted only at a premium and not at a face value or fair market value, considering the prospects of the company, considering the returns that are possible if the company runs properly and smoothly shortly. So this extra amount is paid by the investor to the company for getting the shares allotted. Such excess amount which he pays, that is over and above the fair market value of the share, that excess amount is treated as income, and this income is taxed under section 56(2)(7)(b) as angel tax. I hope the concept of angel tax is clear now. If we understand all this, then what are the benefits of this? The benefit, simple benefit is the entrepreneur gets the capital without security as well as without guarantee. How this removal of angel tax will help the entrepreneur, the company, the startup? The answer is very simple. Earlier, when this tax was there, he was required to pay the tax at the normal rates. If he is in the bracket of 20% or 30%, accordingly he will have to pay the tax on that excess amount which he receives from the investor over and above the fair market value. Now this tax has gone, proposed to be removed. Hence, the amount of tax liability will come down. The first effect. The capital in the hands of entrepreneur will be more net of tax. And second benefit which the entrepreneur can get is he will be relieved of the disputes of calculating the fair market value and finding out the excess amount that he has collected from the investor. So it will save his time, it will save his energy, efforts, and also the cost. And less disputes will be there in the assessment procedure. Well, let us welcome this move that is taken by the Finance Minister in this budget 2024.